What if I told you the government built a secret door into the tax code one that lets certain people stuff up to $47,500 extra into a tax-free retirement account every single year? Not $7,500, not $14,000, $47,500. And the IRS knows about it. They literally allow it. It's called the Mega Backdoor Roth, and almost nobody talks about it because most financial advisors assume you don't make enough to need it. Here's the problem. The government tells you that you can only put $7,500 a year into a Roth IRA in 2026. And if you make over $168,000 a year as a single filer, they tell you, sorry, you can't even do that. You make too much. No Roth for you. So millions of high-income Americans, doctors, engineers, business owners, are stuck watching their money grow in accounts that will eventually get taxed. It feels like the tax code is designed to work against you the more you earn. But there is a legal workaround hidden inside your 401k plan. And today, I'm going to break it down so simply that even if you've never invested a dollar in your life, you'll understand exactly how the Mega Backdoor Roth works, whether you qualify for it, and exactly how much money it can save you over your lifetime. Here's what we're covering. What the Mega Backdoor Roth actually is, how the regular Roth works, and why it fails. High earners. The 3 buckets inside your 401k. Nobody tells you about step by step. How the strategy works, how much money you can actually move with real 2026 numbers. The catch, what can go wrong, and whether this is right for you. Let's get into it. First, a quick refresher. A Roth IRA is one of the best retirement accounts ever created. You put money in after you already paid taxes on it. That money then grows completely tax-free. And when you retire and pull it out, 0 taxes, none. Compare that to a traditional 401k, where you defer taxes now but pay them later in retirement, when you might be pulling out hundreds of thousands of dollars. The problem? In 2026, the standard Roth IRA contribution limit is just $7,500 per year, or $8,600 if you're 50 or older. That's not a lot when you're trying to build serious retirement wealth. And it gets worse. If your filing status is single or head of household with an annual income of $168,000 or more in 2026, contributions to a Roth IRA are completely off limits. For married couples filing jointly, the income limit is $252,000 in 2026. So if you're doing well financially, congratulations. The government just locked you out of one of the best tax deals available. That's exactly the pain point the Mega Backdoor Roth was designed to solve. It's not a different account, it's a strategy, a specific sequence of moves inside your 401k that legally gets you around those limits. And the numbers are dramatically bigger. To understand the Mega Backdoor Roth, you need to understand something. Most people, even people with 401ks for years, don't know. Your 401k isn't just one bucket. It actually has 3 separate buckets of contributions. Bucket 1, your regular pre-tax or Roth 401k contributions. In 2026, your own elective 401k deferrals are capped at $24,500. That's the limit most people know about. Bucket 2, your employer's match. Whatever your company chips in, that goes in bucket 2. You don't control this one. Bucket 3, after-tax contributions. This is the less-known bucket, and it's where the magic happens. Most people don't even know bucket 3 exists, and most 401k plans don't advertise it. Why? Because not every plan allows it and employers aren't required to offer it. The IRS sets a total annual limit on all 3 combined contributions. In 2026, that ceiling is $72,000. So once you subtract your $24,500 employee contribution, and whatever your employer matches, anything left over is potential space for after-tax contributions. That gap is where the Mega Backdoor Roth lives. All right, here's the actual strategy step by step. Step 1. Max out your regular 401k contributions for the year. In 2026, that's $24,500 if you're under 50. Step 2. Check if your 401k plan allows after-tax contributions. Not Roth contributions, but after-tax. These are different. This is the most important step. If your plan doesn't allow this, the strategy doesn't work for you. More on that in a minute. Step 3. Contribute additional after-tax dollars into your 401k up to the total limit. If your employer matches $10,000, for example, you still have $37,500 more you can contribute on an after-tax basis while staying within the $72,000 limit. Step 4. Convert those after-tax contributions to a Roth account, either a Roth IRA or a Roth 401k. This is called an in-service rollover, or in-plan Roth conversion, depending on your plan. Here's the key insight people miss. The conversion of your after-tax contributions is tax-free because you already paid tax on that money. The only thing that could be taxable is any earnings those contributions generated before you converted them. This is why financial professionals say to do the conversion fast, ideally the same day or within days of the contribution. The less time the money sits in the account earning gains before conversion, the less you potentially owe in taxes. Once that money is in your Roth account, it works exactly like a regular Roth IRA. It grows tax-free. You pull it out in retirement with zero taxes owed. The difference is you just moved potentially $47,500 in a single year instead of $7,500. Let's talk real math because this is where it gets exciting. The Mega Backdoor Roth is an IRS-sanctioned strategy that can channel up to $47,500 in additional after-tax dollars into a Roth account in 2026, on top of your normal contributions. Here's a simple example. Say you're under 50, you max your 401k at $24,500, and your employer matches $10,000. Your total so far? $34,500. The $72,000 overall cap means you have $37,500 left in after-tax space. Contribute that $37,500 after tax, then immediately roll it to a Roth IRA. You just put $37,500 of tax-free money to work for retirement in 1 year, on top of everything else. Now zoom out. Do that for 10 years. At a 7% average annual return, that alone could grow to over $500,000 in tax-free wealth. And not a penny of it gets taxed when you take it out. For those who qualify, the long-term compounding of those tax-free dollars can be worth hundreds of thousands of dollars over a career. This is why the people who know about this strategy treat it like a superpower. All right, now for the part most YouTube videos skip, because it's not fun to talk about. The Mega Backdoor Roth has real risks and real roadblocks. Let's go through them. Roadblock number 1. Your 401k plan might not allow it. Your plan must allow after-tax contributions separate from pre-tax and Roth 401k contributions, and provide mechanisms for either in-service distributions to Roth IRAs or in-plan Roth conversions. Many plans don't. You need to check your plan documents or call your HR department directly and ask, does my plan allow after-tax contributions and in-service withdrawals or in-plan Roth conversions? Roadblock number 2. Earnings before conversion are taxable. If your after-tax contributions sit in the account and earn gains before you convert them, those earnings are taxable in the year of conversion. This is why speed matters. Convert fast. Roadblock number 3. Exceeding the total limit. Exceeding the $72,000 total 401k limit in 2026 can trigger corrections and messy paperwork. You need to count employee deferrals plus employer match and profit sharing plus after-tax contributions. The math has to be exact. Roadblock number 4. It's not available to everyone. This strategy comes with specific rules, plan requirements, and contribution math that can trip up even experienced savers. Here's the bottom line. The Mega Backdoor Roth is powerful, but not plug and play. It requires a qualifying plan, careful math, and ideally a tax professional or financial advisor who understands the strategy. Done right, it's one of the most powerful legal tax moves available. Done sloppy, it creates headaches and unexpected tax bills. So, who should actually consider the Mega Backdoor Roth? Because if you're making $60,000 a year, this is probably not your move right now. The Mega Backdoor Roth is generally most useful for high earners who already max out regular 401k and IRA contributions and expect to be in a similar or higher tax bracket in retirement. Think doctors, lawyers, engineers, tech workers, business owners. People who have genuinely maxed out their other tax-advantaged options and still have investable income left over. People who are earning too much to contribute to a Roth IRA directly, but want the tax-free growth benefits badly enough to work for it. A mega backdoor. Roth can be an excellent tool for high-income individuals who have already maxed out their standard 401k and want more tax-free retirement savings. District capital management. If that's you, or if you're working toward that income level, start checking your 401k plan documents now. Ask your HR department the 2 key questions, and talk to a tax professional before you execute this. This is a strategy worth knowing exists, even if you're not ready to use it today. Let's bring it home. The Mega Backdoor. Roth is a legal, IRS-approved strategy that lets high earners move up to $47,500 in after-tax money into a Roth account every single year on top of their regular contributions, even when their income disqualifies them from contributing to a Roth IRA directly. The 3 things you need to remember. 1. Your 401k plan must allow after-tax contributions. 2. You need to convert those contributions to Roth quickly to minimize taxes on earnings. 3. The total of all your contributions, your employer's match, and your after-tax dollars cannot exceed $72,000 in 2026. This strategy isn't for everyone, but for the people it fits, it's one of the most powerful tax advantages the U.S. retirement system quietly offers. And the fact that most people have never heard of it, that's your edge. If you got value from this, drop a comment below and tell me, did you know this strategy existed before today? I'm curious, and if your company's 401k plan actually supports it, let me know because that's rarer than people think. Hit subscribe if you want more videos like this. No fluff, no motivation, just real financial strategies explained simply.